Capital income is money coming into the business from sources other than regular business operations. It often includes loans, mortgages, or the selling of shares. For instance, if a bakery takes out a loan to expand and improve the store, the loan amount is considered capital income. Think of it as the fuel that powers the engine of your business, allowing you to get it up and running or expand. Here are some examples of capital income a business may have. Loans. When you secure a loan, you're acquiring funds from an external source, often in the hopes of propelling your business forward. These loans can come from traditional banks, credit unions, or even online lenders. They can serve various purposes, such as funding startup costs, expanding operations, purchasing inventory, or investing in equipment. Loans typically come with interest rates and specified repayment terms, which can be short-term or long-term. It's crucial to choose a right type of loan that aligns with your business's goals and financial capacity. Mortgages. For many businesses, owning property is a key milestone. Commercial mortgages provide the means to acquire real estate, whether it's an office building, a retail space, or a manufacturing facility. Similar to personal mortgages, commercial mortgages allow businesses to spread the cost of a property over time, making large investments more manageable. The property itself often serves as collateral, providing security for the lender, which could be a bank. It's a strategic way to gain control over your workspace and build equity over time. Shares. Shares represent ownership in a company and are commonly issued by corporations to raise capital. When you sell shares, you're inviting investors to become shareholders in your business. These shareholders invest their capital in exchange for a proportion of ownership and potentially a share of profits through dividends. Shares can be issued privately or publicly, with public offerings being traded on the stock exchanges. For startups and established companies alike, issuing shares can be a powerful way to fund growth and expand operations. Owner's capital. Owner's capital represents the owner's personal investment in the business, as it's them putting their own money into the business. This often happens to fund the startup of the venture, as it can help fund initial expenses or provide working capital. Owner's capital demonstrates a strong commitment to the business's success and can serve as a source of funding when traditional loans or investments are not readily available. It's a way for entrepreneurs to take full financial responsibility for their venture and reap the rewards of its success. Debentures. Debentures are a form of debt instrument issued by a company to raise capital. They are essentially bonds, typically with a fixed rate, that companies sell to investors. When you purchase a debenture, you're lending money to the company, and in return, the company agrees to pay you the principal amount along with interest at specific intervals. They are a way for businesses to access funding without giving up ownership or control. So, they're the different types of capital income a business could have.